given we touched on ESG, is there a big push, do you think, from clients to go down that route? Or how, as you as a fund as a sort of a fiduciary, how do you balance sort of your responsibility to your clients and responsibilities to these undefined metrics now? Is there a conflict? Is there sort of something you can tell us about that?
Yeah, I'm struggling for words a little bit here, and I'm struggling for words on purpose, for the fact that, to me, we're wealth managers. We're introduced clients from financial advisors, from intermediaries. We don't spend a lot of time talking to Mr. and Mrs. Smith, who are the end consumer.
Yeah.
And by and large, most people's investing that we do is because those investments have been sold, not because they've been bought. Mm-hmm. And if I give you an example, let's say it's a Saturday night and you've just won 100,000 on the lottery. The odds are you'll say, I'll buy a new house, or I'll reduce the mortgage on the house, or I'll buy a car, or I'll go on holiday, or whatever. The odds are you're not going to think, I should go down and see a financial advisor and invest 100 grand. Mm-hmm. If you won 5 million or 10 million, investing would be something that you'd think of, because you've got to do that. But 100 grand is, it's a lot of money.
It is.
But most people would think, I'll have an extension, or I'll have the kitchen done. And to me, you have to, it's something you have to be sold. It's not something I'll go down and see my financial advisor. I need 4,000 a year, so if I can buy something on 4%, that gives me a 4% yield, and I'm happy for the rest of my life. It doesn't work like that. Mm-hmm. So for you to ask the question of, is it something that people want? It's only certain people that will open the door in the first place. Then it's a smaller minority of that that'll say, I'm interested in ESG, or I'm interested in societal benefit, or I'm interested in in ethical or low carbon or gender equality or things like that. And this is where I think there's a major problem with our profession, is that it's an afterthought. And to go back to an earlier question of where things are changing and how things are going to go forward, in the UK, I love the whole auto-enrolled pension bit. Mm-hmm. It's the whole slow nudge. You get in, you invest, and before you realise it, you actually have an investment, and you've got a pot that you can do something with. Again, and another line I heard. And most people, they'll earn X amount, and then they'll put whatever away for their mortgage, and they'll put whatever away for their council tax, and so on and so forth. And they'll have their spending money. And then what's at the end? They might think about setting up a regular savings plan. But if they haven't got it, we won't invest it.
They pay for the expenses first, you're saying, and then they invest.
But what they should do should be the other way around. Is put money into investing, and then do whatever outside of that. And it's the whole Richard Thaler and nudge scenario. Mm-hmm. If you do it and you get into that repetitive cycle, then there's every opportunity.
So what lessons do you think you can teach the average investor, the average nuclear family, about saving and investing money, seeing you do it for the bigger boys?
Yeah.
Are there any lessons that you can extrapolate for those people?
It's exactly the same whether you're saving £50 a month, whether you're saving 5 million a month. Mm-hmm. It's having a plan. It's knowing your short, medium and longer term goals. Mm-hmm. It's knowing that economies don't always go up in a straight line. It's knowing that stock markets are volatile. It's knowing that emerging markets are more volatile than general stock markets, but there is a risk and return profile, and some goes up and some go down. Mm-hmm. It's about having a diversified base. And to me, I think of stock market similar to going into a supermarket. If you buy the same bread and the same meal every single time, mm-hmm. You get the same thing every single time.
Yeah, that's right.
But if every now and then, if you take a trip down the aisle that sells wine, and you've got to buy one get one free,
you've opened yourself up to opportunity.
Yeah, and you might not want to drink both bottles on the same night.
Yeah.
But you've actually made an investment. You've bought 2 lots of wine, and you've actually can put something away and drink it later. Mm-hmm. And you actually, you know what? I got this one free.
So do you think people need to be more actively responsible over their own financial destinies, as opposed to relying on external factors to nudge them into negative directions? Do you think there's a lot of advertising against sort of intelligent, responsible investing? Or is that just an excuse for most people? Or for some people?
A well thought out plan is fine. Having a long term horizon, to me, risk can be measured on so many different measures. People say, "Oh, cash is a low risk investment," but if you put all your money in cash today and expect it to be worth a lot more in 30 or 40 years' time, and keep up with the value of inflation or keep up with the value of anything else, then actually cash is a very, very high risk strategy. A low risk strategy, if you've got a 40-year time horizon, could well be investing in emerging and frontier markets. Because in 40 years' time, these emerging markets will have emerged.
That's right. Finally.
Yeah.
Eventually.
And, you think back to the UK, which is a first world country, allegedly. I remember growing up and knowing that we had there was the 3-day week and there was power cuts. And, if we have relatives in the US that, my dad used to have to phone up the telephone exchange and say, I want to speak to my brother in New York on Wednesday at 8 o'clock, please. The
world's changed so much.
Absolutely.
So much.
And we were a first world country then, and apparently we're a first world country today. But, things have changed.
Yeah.
I was with a fund manager last week who focuses on investing in Vietnam. And, Vietnam's a country with 100 million people. That is almost twice the size of the UK. It's got a very well populated, very young population that's well educated. And you think, the opportunities there are immense. Let's not, I can honestly put my hands in the air and say I'd never heard of Wuhan until a month ago, and Wuhan's got 14 million people in it. And I did some rough numbers this morning actually for a report I was writing, and 14 million people is the population of London and Scotland.
That's right.
And I'd never heard of it. So
there's so much opportunity out there
absolutely,
to really learn about.
Yeah, but going back to the whole point, it's making a plan, it's sticking to that plan, knowing that emerging markets can be risky in the short term, but the odds are that they're going to be less risky in the long run. The same way that cash, which is not risky, if it's a long run, can be very, very risky. There isn't one correct way of building a portfolio. Right. There isn't one correct way. You might have been lucky 6 weeks ago buying Tesla shares at 400 and selling them at 900 3 weeks later or whatever. Absolutely brilliant. Yeah. But as I said, that's lucky. The stock market is it's a weighing machine and it's a voting machine. It takes an awful long time for you to get the returns that you're looking for. And there are short-term wins, but there's also short-term losses. But by and large, if you're willing to build a diversified and balanced portfolio that's willing to accept the risk that you're willing to accept, then given the long run, you should do very, very well. So that's regardless of whether it's a regular savings plan or whether it's a long-term investment.
Do you think this is something that I'm going to track back to your experience for? But I remember when I was at university for my master's at UCL, and we had a careers day. And we had sort of diplomats from the Foreign Office and other departments of government come in to speak about their experience. And because we were obviously studying foreign policy in theory, and we studied all these theorists, all these different kinds of academics about how the world functions or how it should function in their eyes, I asked one of them, I said, how much do you rely on these academics to shape your foreign policy, to shape the response of the UK? And they said, without hesitation, we don't use any of them. Which really took me back, and I thought we're studying all of these things, but in reality, they're not being applied in the way that we're taught. In terms of the investment world, people like Markowitz, for example, who is sort of a legend in sort of portfolio management. Do you, as an active investor now, managing over $1 billion under management, do you go back to academic theories of portfolio allocation when coming up with your strategies, or is it more sort of practical life experience that dictates how you go?
It's both, and it has to be both. You've got to have a very cynical side in the way that you look at work, in the way that you look at investing, in the way that you think of today, tomorrow, and so on and so forth. I remember, I studied financial services at university. I was one of those people that always wanted to get into this into this career. And I remember an article by Dimson. who said, 93% of total returns are achieved by asset allocation. They're not achieved by stock selection. Now, depending on how you look at that, you could say, well, you know what, I could buy the very best cash fund, or I could buy the very worst emerging market fund, and 40 years later, because my asset allocation was to make emerging markets versus cash, rather than the very best versus the very worst of the cash funds or emerging market funds, you could argue that that research is quite flawed. But it does make you realise that when you're weighing it all up, you've also got to think of what is the risk of investing in emerging markets versus the risk of investing in cash, and what are you defining as risk?
Risks as well, you mentioned.
But
yes, not only one type of risk.
Absolutely. And we are very keen here in saying it's risks management rather than risk management. Because if your view is that you don't want to lose any capital, then buying a government debt instrument at launch and holding it to redemption, you're not going to lose any capital.
No way.
The UK government will not renege on a conventional gilt. But if your objective is to achieve 5% income, you're never going to do it. So it's knowing how many goalposts you've got, how many targets you are to achieve, what the objectives are. And off the back of that can help you positively or negatively design or build your portfolio around that, which does make the practicalities of what's happening in real life versus the I don't want to say stale environment that academia is, because it isn't. There's a lot of interesting, new, different things coming out of there. To use, going back to Tesla again, Elon Musk came out with the old Hyperloop scenario a couple of years ago, but actually that was an academic project from the 1960s. He just picked it out. I mean, I've read the document; it's quite interesting. But there's a lot of people come up with nice ideas, and to use the Ronald Reagan line that economists work, it works well in theory, but does it work well in practice? You've got to blend them both together, because again, there isn't one correct answer. And talking of which, we have another saying we have in the office of the answer's 7. What's the question?
Yeah.
And the reason we have that is because there isn't one correct answer. If there was one correct answer when it comes to investing, everyone would have that correct answer,
right.
and the investing industry wouldn't exist.